Yes. So we view everything that we do as stewards for our clients, of course, but also for a greater purpose to be able to give back. And so, I've kept a spreadsheet for the last 20 years just to make sure my charitable giving is, always above 10%. And I find the more I give, the more return I get.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling and compounding your wealth starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. Hey, I'm your host today, Brett Swartz. In each and every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires, and they share their principles, values, and secrets and wisdom with us, providing us each with the insights we need to reach the next level of success, faith, and impact. I am excited about our next guest. He's out of the Washington, D.C. area, Northern Virginia. He also has offices in Texas and California. And he's the founder and CEO of Cornerstone Real Estate Investment Services, as well as a general securities representative in the General Securities Principal FINRA Series 24/7 and 63. He focuses on helping people build and create wealth in passive alternative real estate, mostly Delaware statutory trust. He has an incredible background with accounting, incredible background with tax law, and extensive real estate experience, which helps to assist the clients that they serve across the country. He's part of an elite advisory group assisting in the purchasing of over $2 billion in alternative real estate properties, as well as assisted more than 2,200 investment transactions and so much more. Please welcome to the show with me, John Harvey, John Harvey Jr. John, how are we doing?
Great, Brett. How are you? So glad to be here. Thank you for having me on your show.
So we got to meet in Dallas at the Redemptive Real Estate event, which was a phenomenal event. And we sat at the table and we started to talk a little bit. And I think you might have been speaking on stage or you're on a panel.
Yes, we were a sponsor.
Yeah, you're a
sponsor. Real Estate. And it's the second annual meeting, conference that we've had. The first one was in Santa Barbara, California. And so happy to get into that organization so early on. It's so many people doing such good work out there with real estate.
Yeah, leading with faith and impact and making a difference and bringing the expertise together, which is what we're going to be talking about today, which is a new way of giving and a new way of giving through real estate, highly appreciated real estate, which is so cool. You're pioneering that. But before we go into all of that, John, would you give our listeners just a little bit more about your story and your current focus?
Yes. So I have a kind of a long story. Began, with accounting, like you mentioned, at USC, and got my CPA back in '99, and I basically began to work in Beverly Hills with Ernst & Young, and my first client, some of your listeners may know him, was Johnny Carson. So I did.
Johnny Carson, that is so cool!
Yeah,
wow! Because you meet Johnny, what did that story go like?
Yes. Burt Bacharach, Walter Matthau. So I know how much Johnny gave in alimony. It's a secret, but I know how much he gave in alimony. So I kind of got my start with the rich and famous there in Beverly Hills. Not a bad place to start. And then later on, I got a master's in taxation and was a senior manager with Deloitte & Touche. But in the 90s, I actually lived in Russia. I went there and I was a missionary in Russia after the Iron Curtain fell. And came back, and basically that's when this industry really began that I'm involved in. It began in 2001. In 2002 was an IRS revenue ruling that really gave birth to our industry, and it allowed for a fractional ownership interest. At that time, it was a tenant in common. A couple of years later, in 2004, they issued a revenue ruling on what we call the Delaware Statutory Trust. And unlike an S corporation, unlike an LLC, unlike a limited partnership, the acquisition and the selling of an interest in a Delaware statutory trust will qualify for Section 1031 like-kind exchange. And many of your listeners who are in real estate probably know about 1031. It's actually over 100 years in the tax code. It was implemented in 1921. As a way for, as long as you can maintain your investment, in real estate, in investment real estate or real estate used in the trade or business, you can defer 100% of your capital gains as long as you reinvest into a property of equal or greater value.
Mhm.
You have equal or greater debt, and you use all your cash. You can have a 100% tax deferral of any capital gain that you've accumulated over the years.
Absolutely. I love it, John. And I love your background. I love the CPA part. I love the master in taxation. I love the, serving and going overseas into a place that was risky and scary and a lot of different things, but you served and you have a heart beyond just your expertise and what you're doing, right? Which is fantastic, which is part of why we're at the redemptive real estate part of it.
Yeah.
This is so cool. So the focus is like focusing like a laser on the Delaware Statutory Trust, 1031 exchanging into that.
Mm-hmm.
Talk to us about a little bit of the debt piece, right? I think this is a part where some of the clients, they look and they go, man, like the equal or greater debt can sometimes be a challenge if they're trading out of, let's say, 3.5%, 4% debt, and now interest rates, let's say 6 or 7%,
Mm-hmm.
and the negative arbitrage situation can occur. So do you feel like the market and pricing has adjusted to what it was 2 years ago, or what's your gut feeling for that overall, just where we're at in the marketplace?
Yes. Well, of course, we were at 21-year high on interest rates the last couple of years, and we're seeing some relief there from the Fed, but of course the 10-year Treasury is maintaining at the higher rate. So we haven't seen rates come down, although we expect them to come down over 25. So we think it's a great time to invest. And of course, there's a direct relationship with interest rates and cap rates. So we think we'll see some good cap rate compression. And we're already seeing that, Brett. We're already seeing prices adjust kind of to the new reality. So it's an excellent time to invest. A lot of positive feeling out there as far as investment and deregulation, with the new administration coming in. So we're really poised for a really good year, I think, for 25 and 26 for real estate.
I think that's phenomenal. By the way, I have a concept that we've been really working on here at Capital Gains Tax Solutions, which is tax flow, debt flow, and cash flow, right?
Yeah.
And figuring out which product to use for which part of it. Now, what I love about the Delaware Statutory Trust is the debt is no longer in your name, right? It's non-recourse debt.
Exactly.
It's already secured by, these large, it could be a Hobby Lobby, it could be a FedEx office, it could be Amazon, it could be the tenant, it could be a number of different, it could be an apartment complex, right? Or complexes, multiple ones. And the debt is not in your name. And so this idea of if you're going to be doing a 1031 exchange and you're going to be, paying for something within that 45,180, the question is, will that debt be in your name or someone else's? And that's the cool thing about the Delaware Statutory Trust. Would you talk about that?
Absolutely.
And how that can get people what I call debt free? I call it the Dave Ramsey, way to get debt free, because at a certain point in your life, you don't want to be dealing with the toilets, the trash liability, and the debt, especially.
Fees. Exactly. So yes, under a Delaware Statutory Trust investment, the way that they're structured and they're syndicated, it's a non-recourse loan. As I mentioned before, when you do a 1031, you have to have equal or greater debt on the new property, on the replacement property, as you did for your relinquished property. If you have any decrease in your debt, then that is mortgage boot, and you have to pay tax on that. And unfortunately, the taxes start at the depreciation recapture rate, right? So the IRS requires you to recapture the depreciation at 25%, plus you have the Affordable Care Act at 3.8%, plus you have your state and local tax. It could be 5 to 9%. So you're really going to get taxed heavy if you have any decrease in your mortgage, or if you have any mortgage boot. So, which, as you mentioned, Brett, and you're so well versed in this, I'm so happy that you know all the facts, is that this, on the Delaware Statutory, you have a non-recourse loan. Now, so that means, of course, that the lender only has recourse against the property and not against your personal investment. And it's very interesting, the Delaware Statutory Trust has limited liability, and it has the same limited liability protection as a Delaware corporation. And as you know, of course, Delaware is excellent in maintaining the corporate veil, not allowing lenders or any other person to try and pierce that corporate veil. So it's a very excellent jurisdiction. But under the Delaware Statutory Trust, not only do you have a non-recourse loan, but the trustee is signing the typical carve-outs that you have in your non-recourse loan. So typically in a non-recourse loan, you have the investor, the owner has to sign carve-outs for fraud or what we call any kind of bad boy provisions. So there is a little bit of exposure there. But under the Delaware Statutory Trust, the trustee is signing that. So it is an absolute non-recourse loan, absolute non-recourse. And as you mentioned, it's really out of your name. The loan then is in the name of the trust. You don't have to qualify for the loan. The loan never appears on your credit report, and you never have to service the loan. For all intents and purposes, the loan is vanished. But you get all the benefits of the loan, right? You get you own more property, right? You have not only your equity investment, but whatever the debt you assumed. So if the property appreciates, let's say 10% in a given year, and you have 50% leverage, then instead of making 5% appreciation, you're making 10. And so you have those benefits, and also a really kind of very unique benefit here is that if you increase your debt, if you actually go up in your debt, then you have additional basis. So on a 1031 exchange, because you're deferring the gain, you have to carry over your old basis to the new property, right? And many of our clients, they pretty much exhausted all their depreciation, and they're no longer able to shelter the rental income that's being spun off of the real estate investment. But if you increase your debt, then that becomes new tax basis, and so we'll be able to depreciate that new basis over a brand new useful life. And in many cases, in most of the cases, the Delaware Statutory Trust investments will have what we call a cost segregation study, and we'll be able to allocate some of that acquisition price to shorter use life assets like 5, 10, 15-year property, and take bonus depreciation. So in many cases, we can fully shelter the cash flow for the first 3 to 5 years from federal and state income taxes. So there's a lot of very interesting.
We're going to break this down for because what John just said is really the one of the beauties of what we call cash flow, debt flow, and tax flow, right? So you're trying to get all three to do what's called a 3D investment, right? 3D investment, not just a 1D or 2D. You got to really look at all three of these, because the people who got in trouble or are in trouble right now is because they have too much debt that has readjusted. They didn't keep their debt flow in mind. They took it maybe for granted, or maybe they couldn't get the loan that was fixed for a longer period of time. Yeah. And now their cash flow is sinking. The debt flow is sinking and is decreasing the cash flow, or it's going negative. So the whole thing is falling apart, right? So you got to have tax flow, debt flow, and cash flow all in sync here. Okay. So what he's saying is we're going to sell, and get the debt out of your name, right? And then to the extent that you take on even more debt, you'll get additional basis, because one of the downsides with the 1031 exchange is your basis travels. So what John's referring to, if you had a zero basis, and if you bought, say you said a $10 million apartment complex you've owned for 30 years, so you're fully depreciated. If you were to sell and just buy another $10 million property, guess what? You have no additional basis, right? And if you were to just put a $10 million into a Delaware that had no debt on it, you have no additional basis. And let's just say the cash flow is 5%, so that's $500,000. That means all of that $500,000 is taxable. There's nothing to offset it. Now let's shift it a little bit. Now let's imagine you did a 50% basis, right? So you bought something that was $20 million, right? And so you have additional $10 million worth of basis. Is that what we're saying, John? You kind of get almost kind of like a bonus of a basis because you took on the debt. Did I say that correctly?
Exactly. That's correct.
Okay. Now let's take that 10 million and let's imagine that the cost seg on that, on average, you said 3 to 5 years. So let's say it is still 5%. You're saying if we got 500,000 for the first 3 to 5 years, it'd be a zero on the paper on the K1 that's issued to you. Is going to show more depreciation loss to offset the cash that's been paid to you. Therefore, you should have zero tax on that first 3 to 5 years. Is that a fair summary, John?
Yes, that's a fair summary.
Okay. Anything to add to that?
On the cost segregation study, we're usually able to allocate about 25% of the investment to those shorter lived assets that we can take then as bonus depreciation under the 2017 Tax Act.
It's so great, right? And now Trump just got elected here, so let's see if he takes it back to 100% bonus. Right now we're in 40%, right? 40, 60 or 40? 40? 40. Yeah, next year is set to go even lower, right? And so we want, or potentially they're going to get it back up to 100. So John, if they get it to 100, do you think that's what takes it to the 5 year, or do you think it goes to 5 or 7?
It depends how much, carryover basis you have or additional basis from the additional debt. So, And you can take it all in the first year. You can elect it under Section 179, and then carry over anything that you don't use. And so typically we can get you to be 3 to 5 years, depending on how much basis you have to play with.
Okay, cool. So hopefully everyone's getting that. If not, you need to rewind that, understand that piece. We're going to go a little more technical here before we get into the topic at hand. We haven't forgotten about it, right? Which is a new way to give an investment in real estate, but you got to understand this tax flow, debt flow, and tax flow as it pertains to the Delaware Statutory Trust before I think we can go into that. One other piece of this would be the zero coupon, right? So people have what's called debt over basis issues where they have this massive amount of debt. So let's do this scenario again. You have a zero basis, $10 million worth of a property sale. Let's just say you had $6 million of debt, right? And so, let's say you're in California and you're going to get hit with at least 40% with the depreciation recapture. So the whole thing just kind of falls apart because after you pay off your debt and you pay the tax, you're basically left with nothing after closing costs. Enter the hero, John Harvey, with a Amazon zero coupon deal or a FedEx office building, right? So tee us up on if someone said to you, John, I need a zero. I need a massive amount of debt to replace my debt. How would that work? What does it look like?
Yes. So we have a very unique strategy to be able to effectively de-lever your investment, at least part of your investment, right? So as Brett mentioned, we do have DSTs that we call zeros. And the reason they're called zeros is because we have very high leverage. It's usually about 85% loan to value. And of course, to go up to that high of loan to value, the banks want a very secure tenant. So usually it's, an Amazon, as you mentioned. We've done some other things like Dunkin' Donuts headquarters, Amazon headquarters. Back before, the decrease in the credit rating, we had a lot of Walgreens. But anyways, you get a very solid credit tenant. And then the bank will also want to sweep the cash flow because the leverage is so high. They'll just sweep the cash flow. There's no cash flow on these deals, but you do get 85% loan to value. And because they're sweeping the cash flow, then there's really hyper amortization on the debt. So you're not getting any cash flow, but as that loan amortizes over time, the actual return is not bad. I don't know if I can say what the returns are. We're a very restricted industry, but they're very good returns. Much better than you'd think. And it's kind of like having a savings account, right? You're not getting any cash flow from that deal, but the loan is amortizing. Let's say the cap rate stays the same. When that deal sells in 5 to 7 or how long the hold period is, then you'd be able to realize all that appreciation or all that amortization. And then you could, of course, do another 1031 and then go into the next investment.
Pause. I want to make sure everyone caught this. Okay, hold on. Before we go to the next stage, okay?
Yeah.
Here's really important, right? What John just said. Okay, I'm gonna try to break it down. Sometimes it's good to hear it twice from two voices, right? So your problem, if you have what's called a debt over basis, is that your debt is $6 million and your basis is 0. Okay, meaning if you do not replace that debt and via a 1031 exchange, right, you're going to be hit with ordinary income tax. This is the highest of the high, right? Because you did what's called a cash out refi prior to this at some point, probably, or just took on more debt, however you did it. And that was, tax-free money, which is kind of a concept that we learn in real estate, which is great until it's not. If your debt's resetting and you get caught over your skis, and as Warren Buffett says, when the tide goes out, you see who's been skinny dipping, right? So you got to be really careful when you take on debt. You got to have debt flow, tax flow, and cash flow all in mind. Okay, but you're in the situation. So what do? You're going to first sell the asset. So the $4 million of equity goes into a 1031 exchange accommodator, okay, minus whatever closing costs you have, and we're going to replace that debt, okay, and that debt is $6 million. So we're going to take $6 million, and we're going to take an 85% LTV. So $6 million, okay, is the amount here. I'm sorry, 15% down. So it's going to cost about $900,000. Okay, this is cool, right? Because your $4 million. All it takes is your purchasing power is 900,000 of that, which is not inconsequential, but it replaces that $6 million of debt, and all of that is out of your name, and it is secured. Typically, let's say an Amazon building as an example, or Dunkin' Donuts headquarters. So they're guaranteeing the loan. And then what John said is the reason the bank's doing this is because they have confidence and conviction that Amazon and Dunkin' Donuts aren't going out of business. And number two, they're also saying any of your cash flow that you make of this property, it's hyper amortizing and paying down the debt as
Right.
quick as you can.
Yeah.
That means you're not having to pay down the debt. It's not in your name. And guess
Exactly.
what? You've got about 3.1 million in purchasing power, which you could do a regular 1031 exchange, or you could do another Delaware statutory trust. And we're going to go into this here in a little bit, or you can do a deferred sales trust, which we'll talk about here with John. Looking forward to his thoughts on this. But John, did I miss anything about what we just solved for when it comes to that debt over basis issue?
I think you hit it pretty well, but let me add a couple of points.
Sure.
So you're basically taking most of the debt that you have and you're allocating it to this highly leveraged zero coupon DST. As you mentioned, it's non-recourse, it's not in your name. So it basically goes away and it's being amortized. So that amortization is basically going to bring that debt level down over time.
Right.
Now, the other part of the portfolio that we would put into cash flowing DSTs can then effectively be delevered. So we'll have a much lower loan to value, if any. We have, we have typically 10 or so DSTs that are all cash. So if you wanted to, you could put all your debt in one DST, and then you could put have basically a fully delevered portfolio of DSTs with no leverage that are cash flowing. And, there's kind of a range of cash flows.
It's great. It's like a Rubik's Cube, right? And we're trying to line up all the things and get it lined up and solve this. I think this is just this is the most remarkable thing about the Delaware Statutory Trust.
Right. This is really fun. It's really fun to talk about. I mean, we have a passion for tax planning here at, Cornerstone. Yes. And, with my tax background, this is really what we love to do and get our teeth into. And what you said was incredibly interesting, where you could actually kind of have a cash out refi if you needed the cash. And you before your 1031 exchange, and you need to do it well in advance because there's a matter of the hold period we have to consider, and there's a lot to talk about there. But if you did it well in advance and you had good tax planning, you could take a cash out refi, get that cash working in other things, and then do your 1031 exchange, and then put the majority of that debt, if not all of it, into a highly leveraged deal that would amortize over time. The rest of the portfolio goes into this beautiful, well diversified, institutional grade DST investments that will cash flow and provide good income for you. And,
okay, let's break down these numbers, right? Pausing again. So this is key, right? So John said if you did a cash out refi, like in advance, let's just call it a year to be safe, okay? A year, or you mean calendar year, check with your CPA. We're not giving you those exact numbers, but have some kind of hold period. So it doesn't look like you did a hard money loan 20 days before close of escrow, right? Because then all of a sudden they could see that basically, anyway, don't do that. Okay, so well before, okay. And then when you did sell a year later, right, then you're looking at the ability to just replace the debt, but you already have the cash outside, right? So that's a cool thing. So here's what I'm curious about, because I get this question a lot when we're actually talking with our clients about doing this exact strategy, is they say, well, how long will it take, John, on average to pay down that $6 million of debt? In other words, a lot of the Delawares we see are paying about 5% cash on cash. Do you see that's a general, maybe it's 5 to 7, maybe it's 4, but on these Amazon zeros or these Dunkin' Donut ones, is it about 5? And how many years is a good rule of thumb? Is it, let's say it's $6 million of debt, right? And let's say it's you only put 900,000 of equity, right? So let's just use those simple numbers. Do you think it's 5 to 7? Do you think it's 10 to 12? Do you think it's 13 to 15 years? How many years until do you think that debt would actually be paid off?
Well, we wouldn't get to the point where it would actually paid off, but we will take a good amount of amortization over that whole period. And it could be anywhere from, they're usually a little longer. So typically a DST is 5 to 7 years. But these deals are usually about 7, and they could go longer, about maybe 7 to 10. And so the 10 is kind of the upper limit. Let's
pause there. Let's imagine it was 10 years. How much of my $6 million would be paid off at that point?
I would say about 20. You could bring it down about 20% on your amortization. Okay. And also, every 10 years, very astute listeners are probably thinking, wait a second, I'm going to have phantom income. I'm going to have all this amortization. I'm not having any cash flow. Then that's phantom income. I got to pay tax on that. But the sponsors we work with are very sophisticated, and there's a very elegant solution to that. And that is that there's also a secondary loan with a little bit higher interest that we'll be able to offset that phantom income, so that it's very little, or we can fully mitigate the phantom income issue through some kind of creative structuring.
Okay, got it. Okay, that's awesome. Thank you for that little bonus there. So just to clarify, I did a Delaware, right? I've replaced the debt. On my 4 million, I put 900,000 down, and I got 6 million of debt replacement. If the property were to be held for 10 years, I could expect about a 20% reduction of my debt has been paid down. I'm gonna do the number here. So it's about $1.2 million has been paid down. So in other words, if I wanted $1.2 million if I took 6 million by $1.2 million, that's about 5. So I'd have to wait 50 years. I mean, I know the property's not sitting there for 50 years. I'm going to be selling it, right?
Yeah.
But if I actually wanted my debt to be paid off, I'm basically saying goodbye to the $900,000. I mean, and my kids are going to be able to get the stepped up basis and move that on. Is that a fair summary on that? Or what happens on the Delaware when you do sell in 7 to 10? Are they just putting in another zero that they have lined up and just continue to roll this forward?
Yeah, probably by the time it amortizes, we could put it, into something more conventional, like a DST with, relatively conservative basis.
But it's not going to amortize for 50 years, right? Is that am I missing that? Because the debt is, or at least it's going to get more LTV.
Like 60. Let's say we go from 80 to 60, then we can, we can go into from 60% into a cash flowing deal, and even get some more amortization forward on that. And if you do the math, I think it turns out to be about an 8 to 12% IRR just on the amortization itself, not accounting for any, cap rate compression. If we have cap rate compression, which means an increase in price, the value of the property, then your effective loan to value is going down as well.
Okay, make sure everyone caught that. Okay, so what John is saying there is we're really just trying to get our debt flow and our cash flow and our tax flow in a more manageable LTV, right? Mm-hmm. So yeah, we did go high LTV for that first 5, 7 to 10 years, and our goal is to get about let's call it 15 to 20% of our debt reduction, which moves us into a more traditional 60, 65, 70% LTV, which means we can go into probably some more like apartment complexes or maybe some mobile home parks or something that's going to be higher cash flow. And so do you see how timing is so important here, right? It's so important to understand and to be planning for these kind of things, because if you're not, you're going to get too far down the road, and you're going to eliminate your options to solve these challenges, right? And so, by the way, I want to let everyone know that you can find Mr. John Harvey by going to Cornerstone. It's Cornerstone. DST.com, cornerstonedst.com, or DSTproperties1031.com, where you can learn more about John Harvey, who is an expert in all of this. John, I did mention before that you can go into what's called a deferred sales trust. So this is what we specialize in, right? I'll show you a little bit of my backstory so everyone can hear it, right? Started at Marcus Similichap, 2006. Market falls apart in 2008. A lot of these TIC deals that people were doing got crushed or lost all of their money. Really bad, sad stories for a lot of those ones that happened. I was in California at the time, so a very high tax state. And I'm a new broker just trying to make it in the business. I'm learning about the 1031 exchange. Things are going good for a while, and then the market falls apart. And then it wasn't until about, a 2 year or a year after that, we learned about this thing called a deferred sales trust. And not to be confused with the Delaware Statutory Trust. And it starts to explore this whole idea of tax flow, debt flow, and cash flow, as well as debt tax and different planning. But long story short, we saw clients, for instance, family lose half or all of their wealth because they were doing these traditional 1031 exchanges or going to these TICs. And we're saying there's got to be a better way, or there's at least got to be a way to try to bring the three together: a regular 1031, a Delaware Statutory Trust, and a deferred sales trust, and figure out which part of this Rubik's Cube do I need to turn in order to solve which part of my tax flow, debt flow, or cash or tax flow problem. And long story short, I started to talk about it. People say, "Oh, it's too good to be true. It'll never work." And then now we close properties across the country, business sales, Bitcoin, any asset of any kind. And we really focus on the timing of these investments. And so we will use the Delaware, especially for the Delaware basis, but we use the deferred sales trust, especially when it's not even qualifying for a 1031, like a primary home or Bitcoin or stock or a business sale, right? But also we have clients that do a partial, like where they want to wait for the marketplace to shift, meaning they want better timing of their investments. Like, for example, we did a lot of debt investments 2 years ago, a $13 million asset sale for a client, very low basis in San Diego. They had built a car wash. And so they're in the business of developing and building car washes. They basically built the land and bought the land, built the property for about $4 million, sold for $13.5 million just a couple of years later. Well, we're looking at this and I'm saying, what do you really want to do? And they said, we really want to develop. And I said, well, a 1031 exchange is not going to help you there. They go, we know, because we have to buy something with equal greater value, or go into a Delaware, which they control everything, no diversification, no liquidity, it's all there. And so we did a partial, we did actually a full deferred sales trust. They didn't have any debt over basis issue. And then now we did debt. We invested into stuff that was producing like 10, 11, 12% in debt. The market shifted over the last couple of years, and now we're buying real estate at a discount. And so to me, that has been the aha for me, where I go, deferred sales trust makes sense for the purpose-driven entrepreneur who wants to be able to continue to do deals and have some diversification. I'm curious, I'm sure you've heard of the deferred sales trust, but what are your thoughts on it?
Yes, I think if you bring that into the equation, it just gives you a lot more flexibility. I mean, it's essentially an installment sale type thing under Section 453. So it gives you just more flexibility, more timing, as you mentioned, and to allow for market shifts.
Yeah, exactly. And so that's what we found. And they actually put some of the money in the trust into a Bitcoin at 40,000 a coin. And now we're close to 100,000 a coin, which I think is kind of cool. A small amount. We diversify into some stocks. We had one client did a $17 million business billboard sale, and we did it into NVIDIA, a lot of it into NVIDIA, and that's skyrocketed.
Yeah.
And it's not that they won't get back into real estate. They want to. They just want to be able to buy something when it makes sense for them, right?
Right.
They don't want to be forced into something that puts them in a box, right? They want to be able to create the wealth, to build the next business venture, to build, to lend, to develop. And this can also go into passive funds. It can go into Reg D funds. It can go into active deals. It can also go into Delaware statutory trust as a sliver of it, right? Yeah. And so you're not confined to just real estate, although real estate is our love, but we want to empower the entrepreneur with that. The second thing I'll add here is the debt tax, right? I think one thing that gets overlooked in these Delawares or these 1031s is we're not solving for the debt tax, right? So talk about your unique way with this new way, and now we're finally getting into the topic at hand, everybody, right? After all of this, a new way of giving, right? Is that going to eliminate the debt tax for people if they were, and tell us what this new way of giving is, John Harvey.
Yes. Okay, so a little bit more background though on the DST. Okay. Basically, you mentioned diversification. Of course, we can't go, with the DST. We have to stay in the confines of 1031. It has to be investment real estate for investment or use in the trade or business. So we can't go into Bitcoin like you can. We can't go into the markets or whatever. Yeah. But we do have diversification, within the classical asset classes, real estate. So we have. About 50% of what we do is these beautiful Class A multifamily luxury apartment communities with all the bells and whistles, with the gyms and the dog parks and the pools and everything. Just incredible places for the young people to live. Particularly, it's so difficult to buy a home these days, right? With high interest rates, affordability, everything. There's such a huge demand, and there's about 6.5 million unit shortage, of housing. So it's really being able to fulfill that, to take care of that need in the country. And then we have, triple net retail. We'll have within one DST, we could have as many as 20 triple net retail stores, like CVS and Walgreens and Walmart and Tractor Supply. So within one investment, you can get as many as 20, retail stores. Then we have, these beautiful, best of class student housing properties. There's one right next to my alma mater, USC. I took my daughter on the tour, and she said, "Dad, forget about the sororities. I want to live here with my friends," because they're, they got the pool, they got the gym, they got everything. And then we have senior housing. We have self storage, and also a new development one is we have built for rent, where we have a whole community of single family homes that are built not for sale but for renting, and to allow for people who grow out of the luxury apartment communities to go into a house that they can rent with a yard and more space and raise kids and things like that. So we've got a great amount of diversification, all investment grade. I mean, these are $100-200 million properties. But because of the Delaware Statutory Trust, we're able to bring the minimum investment down to as little as $100,000. And if it's a direct investment, we can go down to $25,000. So for as little as $25,000, if you're doing direct, or $100,000 if you're doing a 1031 exchange, we can go into a property that is really institutional quality. $100-200 million properties, professionally managed, passive, and then spinning off cash flow on a monthly basis.
Pause on that. What's the average cash flow on that? On just all of that?
Okay.
If you had to blend that, what would you say, Johnny? Someone
Average,
puts $1 million in, and they do it across all of that.
4.5 to 7 is kind of what we're seeing in the market right now, and it depends on asset class, right? It's really it's not as efficiently priced as the stock market as far as risk and return, but there is some pricing in there as far as So we can get, we can really take care of the investor. We can get what's suitable for them, according to what their risk tolerance is and what their debt levels. And so we have as many as 50 DSTs at Cornerstone. So we can pick and choose what we like, and then we can also blend that leverage. Now, normally, I mean, we're talking about going into a hyper leverage deal. We just we use that on occasion, but the most of our investors are just going in with, they already have just 30, 40, 50% leverage. So we can blend it and we can get really close to what they want on their leverage. Or if they want more leverage, then we can do that as well. And then, try and increase the shelter from additional depreciation with new tax bases. And then another thing, Brett, is when you're talking about the debt, this has kind of happened over the last couple of years, is that what we're seeing is a lot of the DSTs at the end of the hold period, it's usually 5 to 7 years, but at the end of the hold period, they'll give you another option. So of course you can cash out if you want and pay your tax. That's option 1. Option 2 is you can do another 1031. And you can go back into traditional if you want to, or you can, most of our clients continue to go with the Delaware Statutory Trust, and they, what we call swap until you drop, right? You keep doing your exchange until you pass, and then your heirs get that stepped up in basis, as we talked about. But another third option is that most of these sponsors who offer the DSTs will also have a REIT, a private REIT, and usually these REITs are looking to raise about $1 billion, and they've got 10 to 100 properties. So they'll give you the option to do another type of exchange, what we call a 721 exchange, or an UPREIT, where they can exchange their DST interest for shares in the REIT, in the private REIT. And that's tax-free, right? But of course, that's the end of the road as far as 1031s. You wouldn't, if you ever sold your shares in the REIT, or you either through redemption, there's redemption plans, that gives you some liquidity, or if the REIT goes public, which is basically the idea, then you'd have a fully liquid investment. But when you do that, this is a great thing. And we just realized this a couple of years ago, is that the debt is assumed by the REIT. So you may have that higher leverage, right? But when you do that UPREIT, the REIT will assume that debt. It is gone for all intents and purposes. You just have an equity investment in the REIT. And then, but your whatever basis you had going in. So let's say you did go higher on your debt. You got additional tax basis on that DST, because the DST, again, is fully passive. It's a non-recourse loan. But when that loan is assumed by the REIT, that goes away. It's no longer related to you. The REIT's taking care of that. But your basis in that REIT is the full capital stack, the equity and the debt. So you'll be able to enjoy that same depreciation schedule going on 27.5 to 30 to 39 years if it's commercial. You'll still be able to shelter the cash flow distributions from that REIT with that tax basis that you're going in.
Okay,
Even though the debt is gone.
So I did a $10 million deal. I did it into a Delaware statutory 0 coupon. I had a 0 basis. I had $6 million of debt over basis. I put $900,000 down, and I rode that for 7 to 10 years. That Amazon, that Dunkin' Donuts or whatever, right? It moves into a 721 UPREIT, right?
Yes.
It goes into that one of those. I'm not quite sure I caught what happened at that point, and why not just go straight into the REIT to begin with, right? So are you saying that somehow I get some kind of adjustment?
That's a good point, Brett. That's a great point. If you go into your deferred sales trust, you could go into the REIT directly, right? But if you don't do the deferred sales trust, then what you'd have to do is you have to go into an intermediate step, which is a DST. Right. You need your 1031, right? You want to tax.
Yeah, because you got to get that debt over basis solved. Yeah. But my point is, if it's not already paid off after that 10 years, like it's only down by 20%. Yeah, I'm trying to connect the dots there. You said the debt kind of goes away. Like instead of but the debt still hasn't been paid down to the basis yet.
It's been assumed by the REIT. So the REIT would assume your debt for you.
Okay. But so then would I get hit with I wouldn't get hit with the tax on that debt over basis? So So let's walk through that again, right? So let's say tomorrow I did $10 million, I had $6 million of debt. I had 0 basis. I replaced my debt over basis in a 1031 Delaware's Amazon. The very next year, let's just say hypothetically that that got sold into a 721 UPREIT, right? And so my debt's gone, and what happens?
You have an equity interest in the REIT. It is paying
How much?
distributions.
How much?
Usually, I mean, it varies again, but we're typically it's north of 6% distributions.
Okay.
I should say 5 or 6%, depending on the asset class of the REIT.
Okay, so I guess the one thing that's going on
that,
here, they're assuming the debt. It's kind of like somebody, like the 721 UPREIT is buying your position in the Amazon coupon deal, and it's assuming all of that and everyone else's positions, right?
Yes.
So there's a number of things there, but okay, cool. So they're assuming my debt, and then my equity position is whatever it was based upon the agreed upon sales interest of that. So there's a math equation there. So let's fast forward and let's talk about debt tax, right? So debt tax and solving for that, right? Because at a certain point you're above these exemption amounts and you're going, man, like I need to get that. So will the new way of investing into via Delaware statutory trust eliminate the debt tax?
Yes. So both with the DST and if you were going into the UPREIT, both of those, would have a stepped up basis.
Right. But does not deal with the debt tax, everyone. So stepped up basis has to do capital gains tax. But what about the debt tax, John? What do you think?
The debt tax is, currently at 11 million lifetime exclusion, but that's going to sunset and we're going to go way back down again. I'm sure Trump's going to do something right the Republican Congress to keep that
and
going.
That's per person per year, right? So if you're a married couple, it's like 22, but actually with inflation, we're more like 25, 26 right now.
Yeah.
But, like a good rule of thumb is just if you're between, let's call it 12 and 25 million net worth, you need to be aware of this.
Yeah.
And if you're married, if you're single, it's between basically, you call it 6 and about 12. So you need to be aware of this. But keep going, John.
Yeah. So so the first thing I would say is, well, what's really nice about the Delaware Statutory Trust, and this is also applicable to the UPREIT, is that it's an illiquid investment. Particularly the DST is illiquid because it does not have the redemption like the UPREIT does. And of course, if the UPREIT ever goes public, then you've got a fully liquid investment. But if it's in the DST, you've got an illiquid investment. And so for the death tax, you should have as much as a 50% reduction in the value at the date of death. So that's because of illiquidity. And you can make the argument that if it's a DST within an LLC, if you had an LLC that you were carrying along, you don't need it because the Delaware Statutory Trust is itself a bankruptcy remote entity. But a lot of our clients, they're doing the 1031. We're keeping that entity going along. So you can get a pretty big haircut to the value.
Let's pause. Let's walk through this. Okay, John, let's walk through this. Okay, I want to make sure I hear this right. Okay, let's imagine I'm a married couple. I'm married, right? And let's imagine I'm worth 126 million right now, right? And it's all inside of my taxable estate, right? And it's an apartment complex. So let's keep it real simple. It's an apartment complex in California. I'm 85. I'm 90 years old. It's fully depreciated, right? And I'm like, man, if we don't sell this thing before, my wife and I pass away, we're going to be hit with basically a 40% debt tax on anything above that 26 million. On 100, it's $40 million. So I say, John, just put me into a Delaware statutory trust, right? And so I sell the whole thing. I get into one big Delaware statutory trust, right? And you're saying,
if you had that much, we would go into
whatever, a couple different ones, whatever. Just to keep it real simple. Keep it real simple, okay? Yeah. We're all in there, right? And then we both die a couple of years later, right? You're saying that they would say, okay, your 26 million of exemption, right, now doubles to because it's an illiquid investment. Yeah. You're saying it goes from 26 times 2, so it goes to like 52 million rather than 26. Is that a fair summary?
That is. So there's two benefits. I mean, basically, because you will get that 50%, and this is very standard, for illiquid investments, you'll get that 50% haircut to the value of the property for estate and tax.
Right. Okay. Tax purposes. Yeah.
So if you're just above the lifetime exclusion at the time, then that will bring you down, right? That'll bring you down, and you get to pass everything to your heirs tax free. And we say that is a blessing, a testament of a life well lived, right? You get to pass that on as a blessing to your heirs. What a great thing, right?
It's amazing.
But if you're above it, if you're well above it, like in the scenario you presented there, then what the benefit there is you're going to be able to come down on your marginal estate tax rates. Whatever that 50% haircut is, you're going to be, hitting.
Let's do the numbers. Right? Because I put 126 million into the property, and let's just say 5 years from then it's worth 150 million, or whatever, right? It's 150 million. So then I would take 150 and I divide that by 2. So now I'm down to 75 million, right?
Yeah.
And then we minus the 26 million exemption.
Yeah.
So now we're at 49 million. Now I take that by 40%. So it's a $19 million tax bill. Did I do that correctly? About 19.6?
Yes.
Okay. So my question is, how do I pay the 19.6? I have to do it within 6 months, right? From the time that we both die.
Yeah.
So
you have a valuation election. You can either do it at the date of death or 6 months later.
Mm-hmm.
Yeah.
Oh, okay. On the 19.6 though, how do I pay that, John? If it's illiquid, what do I do?
Yeah. So if it's, so if you're, another strategy, of course, is to be able to gift. And if you're not going to gift,
very good. I got to make sense of this, right? Because I got to find the solution, right? So what happens on how do I get that 19.6 million if it's all illiquid, even though I got that reduction, which is cool?
Yeah.
How do it's illiquid? How do I get the 19.6 million?
Yeah. You'd have to basically divest probably some other investments to pay that.
Okay, so that's a hole. That's a hole. Yeah. That's definitely a hole in this, but okay.
By the time, I mean, it would be a year or two. You'd have to, you could do. Hopefully, you would have, some liquidity from other parts of your portfolio to pay that tax.
Okay,
if not, you can go out.
Here's the concept of this. I want everyone to gather, right? There's not a one size fits all for all of your tax flow, debt flow, and cash flow issues, especially death tax, right? So John and I were saying this is probably what we would cook up, okay? Cook up or a recipe or an idea. We would say, hey, why don't you do 50% potentially into the Delaware Statutory Trust because you can get that 50% reduction. The other 50% go into a deferred sales trust so you can have that liquidity available to be able to, by the way, that 50% we can move, and we call it a DST 2.0. We can eliminate the estate tax on the sale. Okay. So we don't have to go into any illiquid asset. The funds can be liquid, although we like to go into like we call semi-liquid assets, John. We go into 30-day, 60, 90-day debt funds that are paying 10, 11, 12% kind of that range. And so it would probably be a combination of a couple of these because you don't want to go all in on just one thing per se, right? Yeah. And be able to diversify into different assets. Okay, this is cool. I learned something new because I did not know about that 50% reduction. Does it also
apply, John? Too, Brett, we could maybe have a DST where we could have a refinance situation, which we do. Okay. We have that from time to time. Okay. So if you went into all cash on your other part of your portfolio, then we would. We have some sponsors that will do a cash out refi that would give you the liquidity to pay the taxes.
That's great. And you can raise your hand within 6 months. They can do that. Yeah.
Yes. Yes, exactly.
Cool. That's what we're thinking here. John, one other thought I have is, does it also apply if I just bought my own property? So in other words, if I didn't do a Delaware, I didn't do a 721 UPREIT, I just did my 126 million. I just bought my own apartment complex for 150 million myself. It's illiquid. Are you saying that I still get that 50% reduction?
Yes, if it's usually if it's held in an LLC, you'll get up to 30%.
Okay.
But with the combination of the LLC and the DST, kind of the standard is about 50%.
Okay, this is cool, man. I'm learning so much, John. You're doing phenomenal. By the way, if you want to connect with John, you can go to cornerstoneDST.com, cornerstoneDST.com. Not to be confused with the deferred sales trust. He's an expert in the Delaware Statutory Trust, and you always need an expert in the Delaware Statutory Trust for whatever you're doing because you want to make sure you can have multiple options when you go to exit. And then if you're looking for information on the deferred sales trust, that's capitalgainstaxsolutions.com. Okay, so John, this has been so cool. Now can we get into the debt tax? By the way, we just made a whole nother episode because we are at 48 minutes. Here's what we're going to do. Actually, we're actually way over time. The whole time we've been, I guess, call it teasing. We didn't mean to do this, but we had to establish this foundation. So we're going to do a 2-part series. This first part was the foundation here. The second part is going to be on a whole new way of giving, using a Delaware Statutory Trust for tithing, for gifting, for giving, for making an impact, right? For living a life of stewardship over ownership. John is going to come back on the show and we're going to break that down. That's going to be part 2 of this series. Okay. Yes, this is complex. It's because there's 10,000 pages in the tax code. So you're going to have to do some more homework. We're going to give you guys a break here. We're going to wrap up the show with a quick lightning round, and then we're going to come back for the second half. In fact, we're going to rename this entire show multiple ways to exit, using a Delaware statutory trust or a deferred sales trust and a zero coupon. And then the next show will be the charitable one. John, how does that sound?
That sounds awesome. What a great plan. And also, we need another show because we haven't even touched opportunity zones. There's another way we could provide liquidity.
Yeah, that could be the third show. You're right. That could be the third show. So John, let's do the quick lightning round, then we'll wrap it up. John, if you could go back to your 25-year-old self, what's the one gold nugget make sure to tell yourself to do?
Invest early. Don't wait.
Perfect. Yeah. That's awesome. Question number 2. What's the number one book you've recommended the most in the past year?
Oh, the number one book is Building Elite Organizations.
Don Winter.
Don Winter.
Yeah.
I think you might have met Don at the thing. We also have our own book, by the way, Delaware Statutory Trust, which is called Modern Real Estate Investing. And then we have a second one that's called Alternative Real Estate Investing. And that all gets more into the opportunity zones and the UPREIT as well. But those are both available on Barnes & Noble and Amazon.com.
Perfect. We're completely out of time. So this is the very last question, John. And it's the heart of the show, right? It says, how do we practice stewardship over ownership, right? And everything we're talking about here, using our gifts and talents to be a blessing and help more of the MVPs, more people, more families to be great stewards with their wealth, right? So John, what is the number one way that you practice, a mindset and a practice of being a steward rather than just an owner?
Yes. So, basically, we view everything that we do as stewards for our clients, of course, but also for a greater purpose to be able to give back. And so, I've kept a spreadsheet, an Excel spreadsheet for the last 20 years, just to make sure my charitable giving is, always above 10%. And I find the more I give, the more return I get.
I love it. It's so practical, right? Get an Excel spreadsheet, everybody. Break down, track
after tax, Brad. You got to do it after tax.
Okay. All right. That's awesome. I love it. I love it. Hey, John Harvey, it's been more than a pleasure. I absolutely love geeking out about all of this tax stuff. I know our audience and everyone found a ton of value. I can't wait to have you back for the second time. For our listeners who want to get in touch with you, what is the best place for them to find you?
Yes. Our website is cornerstonedst.com. That's Cornerstone DST for Delaware Statutory Trust.com.
Awesome. Hey, thank you, John. I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions YouTube channel and podcast as well. Hey, we're on this journey with you to guide successful entrepreneurs and investors from millions to billions. And we believe that the key to scaling and compounding your wealth and business starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away. I'm Brett Swartz. I so appreciate everyone watching this. Please share this with somebody. It can be of value to, and please rate, review, subscribe the podcast, the YouTube channel. Appreciate everyone out there. Go to capitalgainstaxsolutions.com to get started with the deferred sales trust and looking at your options for exiting businesses, Bitcoin, real estate, having a plan in place. Don't wait. Get started. We appreciate everybody. Talk soon. Bye.